Welcome to Illuminati Silver. We tell the truth about silver. Today is Monday, the 9th of October 2023, and we're deviating slightly from precious metals in that I produced yesterday on the Finances Do Matter channel a video highlighting the end of buy-to-let properties, highlighting why investors are now selling their buy-to-let homes because of rising interest rates, therefore higher mortgages, more regulatory impacts and adverse tax treatments here in the United Kingdom. I'm producing this here simply because when we compare the fact that house prices have fallen in the past 12 months by around 4.7%, and we compare this performance to gold and silver, which in sterling terms has been down only 1% in the last 12 months, but in US dollar terms up 9%. Not quite as good as the equity markets, admittedly, but it is an alternative form of investment. And this is why we're highlighting the end of buy-to-lets, because after all, people putting this sum of money into property may now, no guarantee, but may now decide to put some of that wealth back into precious metals, particularly if we start to see interest rates begin to fall. We are reading an article published by Bloomberg verbatim, which is an excellent article published just a couple of weeks ago. So let's get to it. Okay, now first of all, just to mention, it's not my intention normally in these videos just to look at an article and read it verbatim. But this article is so good, published on September the 20th, I am going to read this one verbatim and show you it on the screen. Hopefully you can see it and share with me the views expressed in this article, which are pretty close to the views that I have on this issue. The golden days of buy-to-let in the United Kingdom are over. Who would want to be a landlord in this market? Published by Merrin Somerset Webb, senior columnist for Bloomberg Opinion. Who wants to be a landlord? Look at the speed of rent rises across the UK and you'd think everyone would be mad for it. A report just out from Hamptons shows rents on newly let UK properties rising at one of the fastest rates on record, up 12% year on year in August and up 30% since the beginning of the pandemic. That's ahead of the rate of inflation and 6 times the average annual rise in the 3 years before 2020. Hay meet sunshine. But here's the odd thing. Everyone isn't mad for it at all. Far from it. Instead, says the National Residential Landlords Association, NRLA, a record number of buy-to-let investors are planning to sell. In the second quarter, new buy-to-let mortgages made up only 8.1% of the total market, 40% less than the same quarter last year, according to the Financial Conduct Authority. What's the problem? To answer that, we need to look first at what once made buy-to-let so popular. In the golden years, it made sense. You bought a house with a cheap mortgage. The rent you charged covered that and the costs plus a bit. After 20 years, you have a house for which you paid nothing but the original deposit. Yes, I'm pricing the time spent dealing with tenants and admin at nothing. You might also have made a capital gain, of course, but as long as you never had to sell when the price was lower than the sum of the deposit, the stamp duty you paid, and the remaining mortgage, then any capital gains were a bonus. The key here is that the traditional buy-to-let investor didn't need to be interested in the things investors usually focus on, such as yield and capital gains. They just needed to break even on a cash flow basis every year, and there was an almost free house at the end of the game. Lovely. Not so today. All the things that made this work have reversed. Look at the costs. Rates are an obvious problem. The average 2-year buy-to-let fixed today will cost you 6.54%, nearly 2 percentage points more than this time last year, according to Manufacts. If you had been looking for a 2-year loan 2 years ago, even 5 years ago, you would have paid more like 3%. There is no way to put a positive spin on the pain of having taken out a mortgage when the base interest rate was 0.1%, as it was in November 21, and refinancing when it's 5.25%. But there's more to higher costs than the rate shock. Think taxes. Back in 2015, a sharp rise in rates would have hurt less, largely because you would have received remarkably generous tax relief on your mortgage payments. That relief is gone. Even before the rate rise of the last few years, the effects were bumping up buy-to-let tax bills and pushing cash flows sharply into negative territory. To this, you must add rising regulatory costs. It is hard and getting harder to evict bad tenants. For example, it can take 6 months plus to reclaim a flat, says the NRLA. Then you must add net zero rules. Landlords are being forced to have energy performance certificate ratings of at least grade C, with huge fines for those that don't make the grade in time, though the rules may change. Fewer than 50% of landlords currently have a C rating. Fixing that doesn't come cheap if you own Victorian terraces. So why not sell up to an owner-occupier who doesn't need an EPC rating for now? There's more. Since the boom days of buy-to-let, a few extra wealth taxes have been tipped onto the landlord's load. There is an extra 3 percentage points of stamp duty on every purchase and an extra 8 percentage points of non-index capital gains tax on every sale. Finally, there is rent control risk. The eagle-eyed will have noticed the Scottish rents on new leases are up more than the average, 13.4% in the last year. That's not because Scottish landlords are uniquely lucky. It's because Scottish rent controls only allow for a 3% rise in rents for existing tenants every year. That makes landlords both keen to leave the market and desperate to push up rents between tenancies if they are staying on. The result is that buy-to-let purchases in Scotland are at a record low and rents are up 43% since the beginning of the pandemic. All these things are more likely to get worse than better in Scotland and the rest of the United Kingdom. Labour appears no fonder of landlords than the current government. Why risk finding out if they intend to extend rent controls nationwide or to align unindexed capital gains tax rates with income tax rates? If house prices were still rising fast, all this might not have been enough to push landlords out, especially if they were guaranteed capital gains at the end. But they're not. Given the above, it's hard to see how they could. House prices fell at an annual rate of 5.3% in August, according to nationwide numbers. The number of mortgages in arrears is rising too. The latest Bank of England figures from its quarterly survey of lenders show they're up nearly 30% on last year, and that's with another 1.6 million borrowers needing to refinance over the next 12 months. It's still a very small percentage of the total, just over 1%, but the direction and speed of travel are unnerving. Give it another 12 months, and both arrears, for sales, and prices might take a very nasty turn. For the last few decades, low interest rates, lowish regulation, and sharply rising house prices have made buy-to-let the dream investment. Everyone wanted to be a landlord. Today, no one does. That's not great for landlords, but it's absolutely terrible for tenants. Yet the government ministers who claim to be on their side appear not to have noticed. Well, I don't know about you, but I certainly found that article most interesting. And let it be a caution to us all that whenever there is an opportunity to gain considerable investment returns, and the general public as a whole take advantage of such possibilities, you can rest assured that the government will come along and tax you or even reduce those benefits. Which is why, in the long term, at least precious metals so far have been left alone, with the exception, of course, of the VAT tax treatment of the white metals, apart from gold, here in the United Kingdom, and hopefully with the demise of buy-to-let property acquisitions and, of course, the money received from the sale of those properties, one can keep one's fingers crossed that an element of this wealth will move back into precious metals. Thank you for watching. We'd appreciate it if you would give this video a thumbs up, subscribe and press the bell sign. Until our next video, we'll see you soon.